Hello, I'm Ali Reza Talibi. I help smart people like you make smarter financial decisions. Thank you for watching. Retirement is one of the biggest financial decisions of your life. But the question is not simply, do I have enough money to retire? The better question is, can my retirement plan actually survive the real life? Because retirement readiness is not just one number. It's the strength of the whole system. Spending, income, taxes, investment rates, healthcare, insurance, estate planning, flexibility, and behavior. In this video, I want to give you a practical way to think about retirement readiness. I've talked to so many people when they come to me and we have a conversation regarding retirement. They usually ask me, okay, what is my number? How much money I need to have? So for sure that can be very useful, but it's incomplete. A single number doesn't tell you how much you will spend. It does not tell you when to claim Social Security. It doesn't tell you how taxes will work. It doesn't tell you whether your portfolio can handle a market decline early in retirement. It doesn't tell you how healthcare or long-term care might affect the plan. So it doesn't tell you whether one spouse will be financially secure if the other dies first. And for sure, it doesn't tell you whether you're emotionally ready to stop working. So that's why when we talk about retirement and when we refer to retirement readiness, it's not just based on a specific number. It should be evaluated as a system, not just a portfolio balance or a specific amount. So a few times I talk about retirement readiness, and I mentioned it's not just a specific number. So retirement readiness has many parts. A strong retirement plan should give you clarity in several areas. First, spending, as I said earlier. What will your life actually cost? The second is the income sources. Where will retirement income come from? Third is regarding your portfolio withdrawals. How much can you actually withdraw from which account and in what order? So which account you should take the money first from. Fourth will be your tax strategy. How will taxes gonna impact the withdrawals, your Roth conversions, Social Security, Medicare premiums, and required minimum distributions? And the fifth one is healthcare. How will you cover medical costs before and after Medicare? Number six is your long-term care plan. Do you have any specific plan? What happens if you or your spouse need care later in life? Number seven is your estate planning. Are documents, beneficiaries, and legacy intentions organized? Number eight is about flexibility. Can spending adjust if markets, inflation, or health costs change? The number nine is actually emotional readiness. What will retirement mean for you? What it means for your identity, for your routine, for your purpose and relationships. These areas together they actually determine your retirement readiness. Retirement planning should begin with spending. Many people they use a very simple rule of thumb, which is based on 70% or 80% of the pre-retirement income. So they said I will need at least 70% or 80% of what I used to get before retirement. For sure, that's a very good starting point, but actual spending might be totally different. To get a better picture and a better number, we need to ask a few questions. How much I'm spending now? What items I'm spending my money on? What will change in retirement? Will the mortgage be paid off? Will travel increase? Will healthcare costs go up? Will I support children, grandchildren, or even aging parents? What expenses are inflation sensitive, which means when the inflation goes up, when the prices go up, those expenses are going to increase as well. What expenses are essential? When I say essential expenses, I mean housing, food, utilities, insurance, healthcare, transportation, and taxes. What expenses are discretionary? So what are these expenses? These are travel, gifts, dining, hobbies, and lifestyle upgrades, which usually we have control on. This distinction matters because flexibility is relevant, powerful, and important here. A retirement plan with flexible discretionary spending is much more resilient, much more powerful than a plan where every dollar is fixed. So, what are the sources of retirement income? There are several sources which we need to consider. So we can actually map the retirement income sources. This may include Social Security, pensions, 401k, 403b, IRA, Roth accounts, taxable investment accounts, rental income, business income, part-time work, or deferred compensation. Each source has different tax treatment and timing issues. For example, when we talk about social security claiming, these kind of decisions can hugely impact on the lifetime income. They can impact on the survivor benefits and also tax planning. The pre-tax retirement accounts create taxable income when they are actually withdrawn. Roth accounts may provide tax-free qualified withdrawals, which they seem appealing when you retire because you don't need to pay any taxes when you withdraw. The taxable accounts may create capital gains, dividends, or interest income. The rental income may provide some cash flow, however, it also creates maintenance, vacancy, tax, and liquidity considerations. The business income may continue, so it might provide some passive income. However, it might also be uncertain. So the goal is to create an income map. Not all retirement dollars are the same. Where the money comes from matters. Retirement planning is not complete if we don't consider the tax side. Taxes can significantly affect retirement readiness. Retirement tax planning includes pre-tax withdrawals, Roth conversions, required minimum distributions, capital gains, social security taxation, Medicare IRMA, which is actually your income related monthly adjustment amount, and estate taxes. Tax brackets and deductions, we know they change over time. Also, the contribution limits, they change over time. The retirement rules, they also change over time. So that's why retirement planning should be kind of dynamic, should be flexible, and we should consider all these changes. For example, some retirees may benefit from Roth conversion in lower income years before required minimum distributions actually begin. Others may need to manage capital gains carefully. Some may need to coordinate withdrawals to avoid unexpected Medicare premium increases. Some may need to consider charitable giving strategies. My key point here is retirement income is not just about what you withdraw, it's about what you keep after taxes and costs. So a retirement plan should be stress tested. What I mean by that? The question here is, can the plan survive the real life? For example, if there is a major market decline early in retirement, what's going to happen to your retirement income? What happens if inflation stays higher than what you're expecting? What happens if one spouse dies earlier than expected? What happens if healthcare costs rise? What happens if long-term care is needed? What happens if returns are lower than expected? What happens if taxes are higher? So the whole idea here is, are we considering all these what if scenarios? How bulletproof is actually our plan? These are meant to create the preparedness. I'm not asking this question just to scare you, okay? So we just need to make sure we are ready. A strong retirement plan does not require everything to go perfectly. However, it should be flexible enough to adapt. That's why cash reserves, diversification, insurance planning, tax planning, and spending flexibility all matter. Here, I have a very simple way to think about your retirement readiness. Green means you understand your spending, income sources, tax strategy, healthcare costs, and a stress test. You're not relying on guesses, so you have some solid actual numbers. Yellow means you have some assets, but your assumptions are not very clear. You may have enough, but you have not tested the plan. And the red means that you're actually guessing. You may be focused on one number without understanding the spending, taxes, healthcare, market risk, or flexibility. Before retiring, don't ask only whether the portfolio is large enough. Ask whether the full plan is strong enough. Retirement readiness is not just one number. It's spending, income, taxes, healthcare, investments, flexibility, and behavior working together. So I've seen so many people that they might be in yellow and red kind of situation. However, still you have time, still you can plan for retirement starting today.